to get paid every month from your stocks without ever selling a single share? That's exactly what income ETFs like JEPI and JEPQ do, but there is a catch you need to know before diving in. JEPI and JEPQ generate monthly cash flow using covered calls and equity linked notes or ELNs. JEPI currently yields about 7 to 9% annually and focuses on large US companies with a lower volatility approach, which can make it more stable during market swings, while JEPQ, on the other hand, yields around 8 to 11% annually and focuses on technology heavy companies similar to the NASDAQ 100. That means it has higher growth potential, but it's also more volatile. One thing people often miss is the upside gap. Because these ETFs sell call options, they trade some potential market gains for that steady income. In a strong bull market, JEPI or JEPQ might underperform. For example, if the market jumps 20%, these ETFs might only go up 10. That's the trade-off for getting those monthly payouts. Taxes are another factor to consider. Most of the income comes from ELNs and option premiums, which are taxed as ordinary income in taxable accounts. That's why many investors prefer holding these ETFs in a Roth IRA. Inside a Roth, your dividends grow tax-free and qualified withdrawals are also tax-free. In terms of volatility, JEPI is the smoother ride. It tends to perform better in sideways or mildly down markets. JEPQ is spicier. It can rise faster when tech stocks rally, but it can also fall more sharply during corrections. You can hold these ETFs in a few ways. One approach is to combine them with a stable dividend ETF to generate enough income to cover living expenses. Another approach is to hold them inside a Roth IRA, which maximizes tax-free compounding. Taxable accounts are generally less efficient for these ETFs during the accumulation stage because of their tax drag. So here is the bottom line. JEPI is best if you want stable, lower volatility income. JEPQ is better if you're comfortable with more risk in exchange for potentially higher income. Both allow you to collect monthly income without selling your shares, but remember the trade-off for high income is capped upside. These ETFs are not about chasing growth, they're about creating steady income while managing risk, and when used in the right accounts, they can be a very powerful tool for investors who prioritize income.